Hello, hi. My name is Scott Hamilton. I'm a certified financial planner from Austin, Texas, and today we're going to talk about the $1,000,000 bet, and we'll cover it in a format of who, what, where, when, and why. So, who? Well, it was Warren Buffett. He's a famous investor, and he betted against the hedge fund manager. And so the what was, well, the bet was designed to go who would perform the best over a 10-year period, which investment vehicle would perform better. And the winner would give $1,000,000 to the charity of the choice of the other one. So when this occurred was, well, the bet was over the duration of a 10-year period starting January the 1st, 2008, and it went to December 31, 2017. Okay, and then the why, well, Warren Buffett is the greatest investor of all time. He's an active manager, but he also believes that for the vast majority of people, a low-cost investing process style is beneficial. You know, same thing I'm always saying, broadly diversified, low cost. And if you're comparing that against a hedge fund, the way hedge fund operate is it's 220. So 2% is right off the top, 2% expense ratio. Very high, very expensive. And furthermore, if they earn a profit that year, they take 20% of that profit. And this is the way the hedge fund industry operates, and it's an expensive proposition. And Buffett's belief, backed by $1,000,000, bet that a simple, broadly diversified, low-cost strategy, and he used the Vanguard 500 fund, which is very similar. It's a mimic of the S&P 500, and the hedge fund manager used a family of hedge funds combined together, and they averaged them out over that 10-year period. Now, if you'll remember, we had the financial crisis, the Great Recession, so the market, after they started in January 1, 2008, the markets had a pretty bad sell-off, and then they recovered. The hedge funds did not recover anywhere near as fast. So the total return of the S&P 500 was 6 or 7% during that time frame, and it was like 2% for the hedge funds. So Warren won the bet, and it's one of the more famous turning points in the history of active versus passive discussions. And active management has its place. However, it also tends to be expensive and not necessarily repeatable, and it's hard to discern if it's, luck or if it's somebody's skill. So it's pretty simple to say, let's implement a passive strategy, right? And then be broadly diversified, low cost, and I like to include a little bit of global in there. On the other hand, you can have a quant fund, which is in the middle, which does a little bit of either, maybe a 3-factor model based on value, profitability, and growth. But that's a separate story. Anyway, so that's an explanation of the $1,000,000 bet, and thanks for taking the time to watch. Appreciate it.